we're going to look at three types of FX markets here. The carry trade, range-bound markets, and commodity currencies. So let's get going. The carry trade occurs when you have one currency that has a very low interest rate, which is used to buy a currency that has a high one. So you're basically being charged 0.5% or something like that, maybe 0.1%. But then you use that money to buy a currency which might be paying you 5, 6, 7%. And you often win in two ways. So you have to pay a very low interest rate, maybe 0.5%, and you get paid a higher one. So you're just banking that interest. And you're not the only person doing that trade. Everyone's doing it. As a result, the low interest rate currency falls in value against the high interest rate one. So you can make 50, 100% just by the fact that the thing you bought using the currency which has a low interest rate goes up in value, since loads and loads of people are borrowing in the low interest rate currency to buy the high interest rate one. So supply and demand. So you end up doubling your money maybe, due to the fact that the exchange rate between the high interest rate and low interest rate goes in your favor. And remember, you're also pocketing money due to the fact that you're only having to pay a very low interest rate for the money you borrowed, and you're getting paid a high interest rate, which is why everybody's doing it. The range trade is more a normal trade. So if one currency goes down, then the economy becomes more competitive. It's easier for businesses to sell their goods whose price has fallen. The wages that they're paying are paid in their local currency. When the currency falls in international markets, the wages have come down. And so then those economies with the lower currencies, with the lower exchange rates, tend to get a boost from that. And so their economy turns around and you kind of mean revert. That's the typical situation. We're not talking about extreme moves here, but that's going on in the background. The two currencies can also be close, with many economic factors the same. In particular, I'm thinking the Aussie dollar against the New Zealand dollar. They'll be doing business with a lot of trade between themselves. So when one of the currencies moves up, the locals will end up buying a lot of goods from the other one, and vice versa. So you can trade those ones by kind of identifying the ranges, and when the markets fall to maybe the bottom of the range, you buy. and when they're near the top, you sell. And typically, if you have two currencies who are quite coupled, you can trade even in the short term on a range trade basis. So, the sterling euro would kind of have that going on as well. Maybe US dollar or Canadian dollar. And finally, we have the commodity currencies. So these are, countries which have many commodities. So their economy is coupled to how that commodity behaves. So in particular, Canada exports a lot of oil to the US. So when oil goes up, the Canadian dollar goes up. So when oil is up, it means it's very expensive for the US because they're spending a lot of money buying oil from Canada. At the same time, it's great for Canada. So Canada's making lots of money. So the dynamic due to that oil exchange drags the Canadian dollar up. When oil is up, while at the moment oil has fallen, so you have the reverse effect. Suddenly Canada's no longer making as much money as it used to. America's not spending as much money as it used to. Australia and South Africa have other commodities. So South Africa would be a big exporter of gold. So depending on how gold moves, that's going to affect the South African rand.